Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about a VanEck ETF later on, but for now, let's get into today's interview. Very pleased to welcome back to Forward Guidance Neil Dutta, Head of Economic Research at Renaissance Macro. Neil, great to see you again. How you doing?
Good to see you, Jack. I'm doing great. Happy summer.
You too. Neil, we spoke in, January or February? And at the time, you reiterated your call for a soft landing, that the U.S. economy would not enter a recession, a view which you have had for a while and which has played out. In other words, we had not had a recession yet. It seems, however, like over the past
we haven't.
Maybe a month.
People think we've already started, Jack. But yeah.
Well, we'll get into that. Neil. But right now, it seems like you have changed your view. Your view has been evolving over the past few weeks, maybe a month. You wrote it at the beginning of June or end of May that you thought an accident could be brewing, as well as that the risks in the labor market appear to be building in one direction, the direction of not good. So tell us, what are you thinking right now about the U.S. economy, and how have your views evolved since we spoke at the beginning of this year, and why have they evolved?
We're still ultimately talking about how much is the Fed cutting and how much is the economy growing. I still think that's the dominating conversation in the capital markets. And if we're talking about that, that's consistent with soft landing and consistent with, sort of risk appetite being okay. I still agree with that. But I also think that we're getting to a point now where the trade-offs for the Fed are not as obvious as they were a year ago. So the soft landing story is predicated on the Fed playing their role. When I talk about accident brewing, I think for me that basically means that the Fed will look increasingly offsides relative to the data as I expect it to come in, given the hawkish language that we've generally been seeing out of them in recent days and weeks, right? So for example, the last FOMC meeting, okay, we had a dots plot come out, summary of economic projections. I think most observers would agree that it's skewed towards the hawkish end of things, right? I mean, they basically revised up their inflation number. They erased 2 cuts for this year. So now they're at 1 cut for the year. I think a lot of that is just a function of the way the data was coming in up to that point. But certainly Powell didn't really walk much of it back at the press conference. So that's sort of strike one. And strike two has been sort of the, consistent kind of drumbeat of hawkish rhetoric coming out of many of the regional Fed presidents. I mean, Lori Logan was out talking up patience. The St. Louis Fed president was sort of doing the same thing. One of the governors, Kugler, I believe, was sort of on the other end of it. But generally speaking, the rhetoric has been hawkish, kind of like let's stay the course sort of thing. If they keep that up and the inflation data continues to slow, it basically means that they're tolerating, all else equal, tighter monetary conditions, right? Because if inflation is falling and the funds rate is not moving, that means they're basically tolerating higher real interest rates. So that's what I mean when I say there's an accident brewing. I think the Fed's rhetoric needs to begin changing relatively soon. I mean, it's sort of just because you were wrong about the first quarter doesn't mean that the trade-offs are in the same place that they were 6 to 9 months ago. And I think it's important to acknowledge that nobody's talking about, a full-fledged easing cycle. What we're talking about is a recalibration of monetary policy. And I think the risk is the longer the Fed waits and the more the economy slows in the interim, the more they may have to do later, right? So the issue right now, in my opinion, is basically the sort of, you don't want to get into a situation where sort of nonlinear risks begin to build in the economy, right? That's always the risk, is that you have a little bit of an increase in unemployment and that little bit of an increase turns into a lot, right? I mean, the unemployment rate never just goes up a little bit. It goes up a lot of it. And those trade-offs in the labor market are becoming more onerous, in my opinion. If you think about the beverage curve, right, Jack, that's the sort of relationship between job vacancies and the unemployment rate. we've had this sort of, what I would characterize as a very benign cooling in the job market. You've seen excess labor demand come down. You've seen very little increase in the unemployment rate. That trade-off becomes a little bit more challenging going forward, because you're at the point now in those curves, if these relationships hold, where a modest decline in openings at this point will result in a bigger increase in unemployment, right? So I think the Fed is a risk management enterprise. And I think the risks skew towards cutting at this point.
So Neil, part of why you've changed your view is that at the beginning of the year, the market was pricing in 6 cuts by the end of the year, 5 to 6 cuts by the end of the year, let's say, and the Fed had indicated on the dot plot 3 cuts. Now the market is pricing in 2 cuts by the end of the year, and the Fed has indicated on the dot plot just 1 cut. And so even though the Federal Reserve did not hike interest rates, it is a net tightening of policy if forecasted or market price cuts do not materialize. And then on top of that, as inflation falls, real rates go up. So that is also a net tightening. So that point makes a lot of sense to me. Setting that aside, looking at the actual data, ignoring the Fed, ignoring interest rates, what has anything to you materially weakened? What pieces of data? Is it in the jobs market? Is it in GDP? Is it inflation? What stands out to you as maybe moving from the soft landing camp to thinking that the risks in the labor market are more one way?
Well, the risks are clearly one way at this point. And, I think, first of all, the most important development in the labor market over the last, 6 months or so is that the inflationary impulse out of the job market has basically ground to a halt, right? I mean, if you look at average hourly earnings, they're running at about 3.5% to 4%, depending on the time horizon you look at. And if productivity growth is running at about 2, which appears to be the case, that's broadly consistent with the Fed's longer run inflation objectives, right? So if you think about compensation growth equals inflation plus productivity, if compensation growth is around 3.5 to 4 and productivity is around 1.5 to 2, you're basically there. So that's the first point. The second point is just looking at things like the unemployment rate. It is up, okay? I mean, is it low? Yes. Is it, is that consistent with the labor market operating in solid level, right? There's 2 ways of thinking about data: the momentum and the level of activity. And the low unemployment rate represents a very high level of activity in the labor market. But up is up, right? I mean, at the end of the day, it was around 3.5% a year ago, and it's at 4% now. And if you think about, what goes in the summary of economic projections, Zach, what is the Fed forecasting? Okay. What do they look at when they try to set the appropriate stance of monetary policy? They look at the unemployment rate and basically core PCE inflation. What has happened to those 2 variables in the last year? Core PCE inflation is down. Most estimates suggest if you take the CPI and producer price index data, it's probably running at 2.5%, maybe 2.6% year over year as of May. So that's number one. And number 2, the unemployment rate is up to 4%. So if you stick those things into a standard kind of Taylor rule type of model, I think it's very obvious what that means. It means cut. It doesn't mean cut a lot. It doesn't mean light your hair on fire about recession risk, but it does suggest that it's time to cut. And as I say, I mean, I think for me, like, the big story is inflation. I'm not particularly concerned about growth right now. I mean, I think growth is okay. It's certainly not. I mean, I think the gap between myself and the consensus is not nearly as wide as it was last year. I mean, back then, everyone was talking about recession, very weak growth, and I was sort of saying, real incomes are fine. Now that gap has narrowed, but where there's still, I think, more kind of disconnect, or maybe there's more, room, is for the inflation story to continue showing up as, disinflationary pressure. Here's what I know about inflation. Inflation is a lagging indicator historically. So that just means that today's inflation data represents yesterday's monetary policy. So monetary policy calls inflation with a lag. And maybe those lags have shortened. And also service sector inflation, which it was weaker in May, that tends to be sticky because those prices are less sensitive to the ebbs and flows of the business cycle and more responsive to adjustments to consumer inflation expectations, right? So those prices are set with expectations in mind. They don't change as rapidly. And if it's slowing now, the likelihood is that it'll continue to slow at least over the foreseeable future. So I think there's a lot of downward momentum yet to show up in the inflation data. And as inflation slows, and if the risk is that the Fed basically says, well, it's only 1 month. Well, the first 3 months of the year were bad. I mean, that to me creates additional unnecessary risk for the capital markets, because it just says that the Fed is kind of setting themselves up here to be somewhat behind the 8 ball. And so that's why I say, just get on with it. If you're going to be very data dependent, it's important to kind of not only respond to the data as it's coming in, and I think the realized data, frankly, support rate cuts, but you also have to have a decent sense for the direction of which way it might be going. I think if you just look at a simple chart of the unemployment rate and inflation, I mean, I don't like doing technical analysis on economic data, but I think the risks in both of those series are one way.
So you said there are risks for asset prices for Wall Street. Are there also risks for the economy?
Well, sure. I mean, they basically be tightening financial conditions, and if they tighten financial conditions, all else equal, that would mean a weaker economy. But look, I mean, what I would just say is, in the beginning of the year, I mean, there were some people that were still making the bet or the gamble that growth was kind of getting away from the Fed. We had this sort of inflationary boom-like dynamic, momentum in economy. This is going to kind of continue to pressure prices, but I didn't really think that was really a risk at this point. I mean, we have okay growth. We don't have growth that is sort of accelerating anymore. And when you just go down the sort of the components, right? I mean, it's not hard. It's very difficult to get to a forecast well above 2%. I mean, you really have to stretch. I mean, you don't have the sort of positive impulse from housing. We're seeing data come out very recently that, suggests housing activity is likely to be sluggish for the next couple of quarters. Consumer spending looks to be a bit more balanced, right? I mean, last year we had it was around 2.5%. It's unlikely to be that strong going forward, only because, aggregate incomes have moderated somewhat. And, you don't have as much of an impulse from the job market. And it's hard to continue driving down the savings rate. You had a lot of this sort of activity in sort of non-residential manufacturing structures because of the CHIPS Act and, the sort of government programs. But it's unlikely that that's going to continue as well. And fiscal policy is not going to be as much of a tailwind going forward. So it's really hard to come up with like a boom-like economic dynamic. I think so. So growth is kind of benign. We've kind of had our upward adjustment on GDP expectations. That's over. What we haven't really seen yet, I think, is a more meaningful downside kind of adjustment with respect to inflation. And I think as that happens, the Fed will have to kind of respond to that. I think they'll ultimately get there. But what the risk that I'm basically pointing out is that they're very reactive. I mean, if you look at like the Fed's rhetoric, it's highly responsive to incoming data. Like, why are they sounding hawkish? They're sounding hawkish because of things that happened in the first quarter.
Yeah, but there's a little bit of a lag, right?
Yeah, but the idea is that there shouldn't be, right? I mean, like the thing is that just look at the data as it's coming in. If inflation is 2.5%, does that warrant a 5.5% Fed funds rate? I don't think so. I mean, so it's just a simple kind of Taylor rule type of model. I mean, they're basically, I think they're sort of afraid of their own shadow, right? Because they're kind of afraid of, if we cut, is that going to light inflation back up? And I just think that's always a risk. But at the same time, there's also a risk of growth weakening unexpectedly. Because you're overstaying your welcome with this higher for longer business.
Earlier, you said if the Fed tightens financial conditions, I just want to say you were implying that the Fed doesn't cut, not that they hike.
I mean, all of that is just contingent on the inflation data, right? I mean, so I think a lot of what's happening right now is because there's like a highly uncertain. It feels like this. We had like 6-7 months of really good inflation data. We had 3 months of bad inflation data. Then everyone was like sort of, oh my God, they're going to hike again. Like all of those views are premised off that first quarter data, right? We had relatively strong private demand, but that doesn't mean that, past isn't prologue, right? Just because that was the case in the first quarter doesn't mean it'll be the case in the future. And what I would just point out to your audience is there hasn't yet been a month where core inflation sequentially has been stronger this year than last year, right? Like, so January was strong this year, but it was even stronger sequentially last year, and so on and so forth. And if that pattern holds over the summer, you're talking about pretty weak inflation numbers over the next several months. And we can talk about why we think inflation is going to slow down. But I do think the evidence is going to get pretty overwhelming. And I think it's important for the Fed to make an adjustment because, otherwise, I think you could probably sap business confidence meaningfully. And I think that would be a risk, right? Because the only reason the labor markets are holding up is because layoffs remain low. And hiring intentions are also have come down quite a bit, but there's not a lot of cushion, in other words, right? I mean, so if you think about the jobs numbers, right, there's not much cushion between hires and layoffs. If the layoff rate takes up just a little bit, you could see a more meaningful slowing in the labor market. So I think the Fed is kind of, again, in a tricky spot here with the job market. And I think all of that sort of speaks to it's time to get going here.
So if according to the Fed's most recent dot plot or their summary of economic projections, what they're forecasting for, I believe it is Q4 2024, core PCE inflation is 2.8%. Is that below or above where you are kind of, your zone? How does that compare to the rest of, other economists?
It's above where I think it's going to be, because I think you're probably setting yourself up at this point for a series of 0.1s, in my opinion, on core PCE. I mean, you're going to get a 0.1 at the end of, for May. I mean, that's pretty much baked at this point. We'll see that information at the end of June. But you'll likely get a 0.1. And just think about it. I mean, just kind of getting into some of the details. I mean, we had a fairly soft inflation print for May without much support from rental inflation, right? There was some weird rental story in the Northeast. I mean, it could be a sampling issue. I mean, who knows? I think it's a reasonable bet to assume that will not continue. But
it was rental inflation for May was above or below?
I mean, it didn't really change. Right.
Okay.
I mean, sequentially, it was about the same, but a lot of that was a function of the Northeast really shooting higher over the month. It's unlikely that continues. So when you look at the regional breakdown, that was kind of what drove it. But we saw a pickup in used car prices despite the weaker inflation number. I mean, what we know about wholesale auction prices suggests that there's still more disinflation in the pipeline for used cars over the summer. That news is coming through Manheim data, Black Book data. So there's more downside to used car prices. There's continued disinflation coming from new car prices. I mean, auto assemblies are picking up. Demand looks to be stable-ish. So, the inventory situation in the new car market is improving. That should take some of the air out of prices as well. And then that's going to ultimately feed into auto-adjacent services. Things like motor vehicle insurance and maintenance and repair costs. And then, of course, there's still this sort of lagged effect of, rental inflation likely to moderate over the next couple of quarters. So I think that there's a pretty strong and compelling case for weaker inflation if you kind of do this sort of bottoms up exercise. And if you continue to see 0.1s on core PCE, Jack, the bond market's going to respond to that. And so this is one of the, so I guess if I had to make a call, I would say Powell uses the July meeting and the press conference to basically set the markets up for a cut in September. I mean, they may not actually cut interest rates, but essentially they would be, because they would make a very strong signal about the next meeting.
So you're making that call based on what you think is appropriate for the economy, that it would be appropriate to start cutting in September in order to loosen policy and react to lowering inflation and a rising unemployment rate. So most of the time that makes sense, but how do you think about the added wrinkle of that is the meeting right before the election in November, and Powell and the Fed might not, even if they aren't political, they don't want to be accused of being political. How do you think about that?
Well, I think for them, they're damned if they do, damned if they don't, right? If they, let's assume that they don't cut because they're worried about the calendar. And I admit that there's a lot of, I tend to resist the temptation of doing that analysis, but there is a lot of this path dependency argument, right? Like if the Fed can't cut in July, then September is too close. So then the earliest they could cut would be December. But In the interim period, the risk to the economy build in that scenario, right? Like if the markets are worried that the Fed may not cut as inflation continues to moderate and get towards 2%, then that creates risk because it means that the Fed is tightening monetary conditions, all else equal, right? And that would in turn weigh on the economy. So then you might get into a situation where they're not cutting in September, and then they don't want to cut around the election period in November. And what if the economy is even weaker as a result of that? So then you have a new president coming in, and then they go 50. Like, how does that not look political? So I like I said, I think they're damned if they do, damned if they don't. I think they should just follow the data as it comes. And I also think the markets, I mean, there is a lot of this, like the Fed has never cut interest rates in a September meeting before an election. Like these are these sort of like political, I mean, they're like not political. These are these sort of like mindless Wall Street talking points that come out. Bernanke did open-ended QE in September of 2012. Like the only reason they weren't cutting was because rates were at zero. So it's sort of like, it's one of these points that people make, but it doesn't actually make any sense because they did an open-ended asset purchase program, which, I mean, so what, you telling me the Fed doesn't move in front of elections? I mean, they've done it many times. They started a tightening cycle in 2004, which was also an election year. And obviously in 2008, the economy was falling out of bed and they were doing all sorts of things, although there wasn't an incumbent at the time up for election. So I think there's plenty of evidence that the Fed is willing to do what's necessary in an election year. And I think the markets would tend to sympathize with that because that's why the markets are priced for 2 cuts. And that means that they can go in September, and I think they probably will. I think the way I'm thinking about this year is that the Fed wants to keep the option open of going 3 times. They may not say that explicitly, but implicitly, I think that's what the inflation data will kind of make clear. Like if the inflation data slows as much as I expect over the summer, people are going to say, why not 3?
Forward Guidance is brought to you by VanEck. The VanEck Morningstar-wide Moat ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? Moat strives to achieve a simple but challenging task: buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/moatfg to learn more. That's vaneck.com/moatfg. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The VanEck Morningstar-wide Moat ETF is distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks, let's get back to the interview. If, let's say, that a recession occurs once every 7 years, so the odds are 1 in 7. That's the vanilla regular recession odds. If the Fed starts to cut in September, what is your outlook? Is it more or less likely, or that exact same regular 1 in 7 years for recession? How does that change if the Fed doesn't start until December or even later?
Well, the risk for recession will build if the Fed doesn't cut sooner. I mean, that to me, because I think the economy is slowing modestly, and I think unemployment is continuing to rise. I mean, it's not because layoffs are going up, but it's because corporate hiring rates have come down quite a bit. So you just have less. I mean, it's almost like a snowball slowly going down the mountain, right? Picking up a little bit more unemployment, right? You have this sort of slow leaking of unemployment into the system, right? I mean, because the people that have just gotten unemployed, they can't rapidly find work. I mean, so this is the labor market's still more or less fine for people that have jobs. But if you just lose your job, you're going to have, job finding rates have come down, hiring rates have come down. So for those that are looking for work, you're out of a job longer. And so I think as that happens, that kind of, puts this sort of slow upward pressure on the unemployment rate. And I think the risk is, the more of that you have, then those people at some point, okay, it's been 10 weeks, I haven't found a job. Now they start cutting back, and that creates a drop in demand across more parts of the economy, which will then weigh on employment. And then you kind of get this spiraling effect that everyone's worried about. That's always the risk with unemployment, is this nonlinear effect. And I think the reason the markets are still quite buoyant is I think the markets are anticipating that the Fed basically steps in soon enough to stabilize conditions. I mean, that's what the markets are thinking, I believe. The risk is they continue to sound hawkish through the summer.
Yes, and Forward Guidance, name of the show. How the Fed sounds matters a lot, and it may matter even more than how much actually changing the interest rate based on how they sound. That's how the entire or the short-term interest rate structure moves. So the unemployment rate is ticked up from 3.4, 3.5% to, as you said, 4%. Is it accurate to say that a lot of that has been people who were not in the labor force re-entering the labor force, i.e. people who were not looking for a job, now they are entering the job, or as well as immigration, rather than the total amount of people who are employed going down? In other words, how do you square the rise with the rise in the unemployment rate with the strong job gains of non-farm payrolls, which come in at 200,000, 300,000, and appear robust?
It's a very interesting debate when about the payroll data versus the unemployment data. It's the establishment survey of payrolls versus the household survey of employment. Obviously, there are different methodologies, and they're measuring different things. Typically, a wide body of I mean, this is Janet Yellen saying this in 2013. The unemployment rate is the single best statistic for labor market conditions. A wide body of empirical research supports that idea. Obviously, people are talking a lot about revisions to payroll data. I mean, one of the benefits of the household survey is that it's not really revised in that way. And so the unemployment rate is what it is. And what we know about the unemployment rate is that it's up. So to me, that's the dominating factor. I mean, I think, okay, it's nice that payroll growth is running what it is, but ultimately that's not enough to pull the unemployment rate down. Now, if that's the case, that could mean that, we have a higher, we can tolerate a higher run rate on unemployment, to keep the jobless rate unchanged. But, to me, I think those topics are kind of secondary to the main observation, which is the unemployment rate has been rising about 30 basis points every 5 months or so. And if that continues, we'll be at 4.4% by the end of the year, which is 40 basis points above the Fed's year-end forecast. And so you have to tell me why that doesn't happen at this point, because ultimately what sets the table for the labor market and the unemployment rate, like if you think about a simple Okun's law type of framework where you relate changes in growth to unemployment, what ultimately sets the table for the unemployment rate direction is economic growth. And what do we know about economic growth? It's basically running at 2%. Okay. And so that to me, if you think that potential's gone up temporarily for whatever reason, that means that there's more risk to the unemployment rate, I think, than maybe the Fed wants to let on. I mean, the idea that the unemployment rate isn't going to move at all between now and the end of the year, which is what their current forecast implies, I think is a little bit, out there. To me, it's the unemployment rate that dominates this discussion. And that's why they forecast it. That's why there's a wide variety of research that says that the unemployment rate is the best summary statistic. I mean, if you had to pick something to be on an island with, I'd probably just pick the unemployment rate. And it's less susceptible to a lot of these sort of revision arguments that you see with the establishment survey.
So with the unemployment rate from the household survey and the non-farm payroll data from the establishment survey, there's been a huge disconnect. Non-farm payroll have been telling a rosy story, household employment, a much less rosy story. If you had to choose one, would you pick the household survey because that includes the unemployment rate?
Yeah, I mean, I think the unemployment rate is what we use when we think about how we set monetary policy. Like the Fed, I mean, the summary of economic projections doesn't have a run rate on non-farm payroll jobs that they're forecasting, right? I mean, there's a reason why, right? So, I mean, that's one quality the unemployment rate has that the establishment survey of payrolls doesn't, is that the unemployment rate goes into a Taylor rule type of equation. It goes into their projections. So I think, we can talk about the unemployment. I mean, maybe the unemployment rate is a little bit skewed higher because of things like youth unemployment. That was a big reason for why the number went up. But I'm just looking at the trend. I mean, the trend in the unemployment rate is higher, and economic growth has slowed. So that's why I come back to balance of risks. At this point, the balance of risks look more to the, unemployment will continue to go up, then inflation will reaccelerate. And if you believe that, then you should be open more so to easing rates at this point.
So then, Neil, are the people who say the non-farm payroll numbers are giving a false image of how strong the jobs market is because of the birth death ratio, and you're familiar with that argument, are you saying that they're right?
No, I mean, I think that, no, I mean, look, I mean, as you know, like this business is about nuance. If you look at most surveys of how consumers rate the labor market, for all these arguments, consumers still rate the labor market as reasonably solid. Do they rate it as solid as they did a year ago? No. And that's what I'm talking about. But it's still solid. I've never found revisions to be a compelling argument for like overall shifting of the narrative, right? Like even when you consider these revisions that people are talking about, you're still talking about relatively robust jobs growth, even accounting for the revisions that people are talking about, if I'm not mistaken, like these QCEW, measures, the quarterly census employment and wages. You're revising it down to a still relatively positive number. Is it as robust as it was before? No, but a lot of these sort of like, oh, it's all birth death. It's all like this sort of like seasonal factor adjustments that they screwed up. Or, I just think that's all a red herring. It just happens to be the case now that you're seeing some increase in the unemployment rate. But generally speaking, those arguments are red herrings. The government does the best job. The statisticians that collect these data points, they do the best job that they can to make these numbers look, as useful as they can be, and as reflective of what's going on as they can be. But I think if you don't trust the government's data, then look at surveys of how people rate the job market. And when you look at that, people still rate the job market as reasonably healthy. Like it's sort of, part of what's going on here is just these sort of attention-seeking kind of headlines, right? It's like, oh, birth death, oh, big downward revisions. It's like sort of like, see, look at that. Oh, it's like sort of big, bright, shiny object. I would just say that the labor markets are slowing. There's been a cooling in the labor market. I don't think it's getting to the realm of, getting away. It's not getting away from us on the downside, but it has been slowing. The way to make sure that it doesn't get away from you on the downside is for the Fed to step in relatively soon and stabilize sentiment and broader economic conditions by cutting rates.
So do you think generally it is unwise or improper to say, oh, the data is being not manipulated, but the data is wrong for statistical reasons? Like your point is the number is the
data
number.
is never wrong, Jack. Only people get the data wrong. That's what's wrong. And so that's how I view it. That's how I've always viewed it in my career. The data are never wrong. The data are what they are. You can be wrong about how to interpret the data, right? It's like political polling. Right? The polls aren't wrong. It's how people interpret them that's wrong. So it's the same thing with economic information. I think it's important to kind of take a holistic view to all the data. And what I see certainly doesn't suggest an economy that's falling out of bed. But what it does suggest is an economy that's slowing. That's why I would tend to resist these sort of, birth death arguments, look at the revisions. Are we really like you have to look at corroborating evidence, right? For example, like withheld employment taxes are still running at a reasonably okay pace. And so these things kind of move around, but I don't view it as like a big, as big of a deal. If I saw confirmation that consumers were telling me the labor markets are really coming under significant pressure, then I'd get a little bit more concerned. But in fact, you don't see that. You don't even see that from small businesses. Like ask them what their biggest problem is. Are they talking about poor sales being their big problem? No, they're not. If you thought unemployment was rising that rapidly, you'd presumably expect to see firms talking about demand as softening substantially. That's not, in fact, what they're telling you. So I think it's important to kind of seek out corroborating evidence. Are the employment statistics in the establishment survey overstated? Yes. Is that changing the overall story? No, which is we have this continued cooling of the labor market, not a precipitous slowdown, not a cliff diving moment, but we have a benign cooling of the labor market so far. And the idea is we want to recalibrate policy to keep that from being something worse than benign, right?
So when you say the data are the data, I think I know what you mean. And in this sense, I know what you mean. And I absolutely agree with you. Like the number is the number. Your job as an economist is to predict what the number is. If you say it's 150,000 and it actually is 300,000, you're wrong. Even if the actual economy only added 150,000 jobs and you got it to that, you were wrong because the data. So I understand what you're saying about that.
Have you ever seen a situation where the markets are meaningfully moving in one direction or another off revisions to data from a year ago? The answer to that question is resoundingly no. So by focusing on it, like, look, you know my job. My job is I'm a business economist. My job is to take an economics point of view and translate it into a market's call. It's not to play these sort of intellectual games and academic games about, oh, birth, death, oh, the quarterly census on employment. It's sort of like, oh, the business employment dynamics are, no one cares. Like that stuff is just so, it doesn't move the market, And so I think it's just important to like think about what are the things that move the market. And that's the stuff that I'm trying to focus on.
So in that sense, I totally get what you mean. The number is the number, but you do acknowledge maybe, or maybe you don't, that like you said, the data is never wrong. Literally, like the data can be wrong. For example, Dewey versus Truman, the newspaper, came out on poll, assuming on polls, they printed it early, Truman loses when actually Truman won, and he held that thing. And I think it was because they polled people who had telephones, who were wealthier, a different demographic, yada, yada, yada. Like sometimes polls can be wrong. Sometimes data can be wrong, right?
I mean, it's just with the data, it's you're collecting additional information from the tax receipts and making a better estimation for what the employment number is. Is that the same thing as it being wrong? I mean, okay, like I think it is what it is, and they adjust the numbers. But what I'm basically saying is that focusing on that adjustment is sort of pointless because the markets generally do not move on that. I mean, I've never really known a situation where the markets are moving on backward-looking revisions data. I mean, I remember back in the 2010s, there was one outfit that was sort of loudly proclaiming like a double dip recession is coming. Back in like 2010 or 2012. And it wasn't in the data, but their whole view was that, oh, well, the revisions are going to show it. I mean, how is that useful? But I think the bigger point is when people make these arguments about birth, death, and the revisions are going to show a much weaker labor market, what they're really trying to do is basically make policymakers look dumb. Right? Like, because it's like, I was smart, I was right, and these bozos in DC don't know what the hell they're doing at the Fed. Interestingly, though, Powell does acknowledge that maybe the establishment survey is overstated to some extent.
He did in June.
Yeah. Right, exactly. So what are we even talking about? Like, you're not even pointing out anything that people don't already know, right? And that's how you become useful in this business. You have to point out something that people aren't seeing, in my opinion. Like, okay, like, so is it, okay, so the establishment data might be overstated. I grant you that. Is that enough to change the overall story in the labor market over that revision period? No, because we're still talking about relatively solid employment growth. What are we focusing on today? What I'm focusing.
So you said, Neil, when you say relatively solid employment growth, are you referring to the household data employment?
No, the establishment data.
Okay, got it.
Yeah. But what are we focusing on now? Like what we're now focusing on is just balance of risks, and the unemployment rate is going up. I mean, so it's sort of, there are ways to kind of talk about these things without lighting your hair on fire. And I think that's, it's important to kind of think about these things in a sober fashion. But as I say, I go back to my previous point. If the labor markets were so bad, why is it that most surveys of consumer attitudes around the labor market say that they're still pretty healthy? I mean, if you look at the Conference Board labor differential, it's hanging in there. I mean, it's certainly not as strong as it was a year and a half ago, but it's not terrible. And also, if you look at surveys of small business, it's sort of the same thing. I mean, they're not telling you that, the labor markets are falling out of bed. They're not citing poor sales as their biggest problem. I think that that's important. Because if the labor markets were really that weak, you'd expect demand to be a lot weaker than it is.
What do you think is the earliest, if we, in the near future there is a recession, what is the earliest possible start date you think? Maybe earliest possible or 95% confident, you decide, but for a start date for an NBER, National Bureau of Economic Research, declared recession, could you see a recession starting, NBA declared in September? Not obviously they wouldn't declare it in September, they would declare it much later, but that they would declare that it started in September. Could I even get you to the point of saying, there's a chance that a recession might have already started? I mean, I know some people who say recession started in the fall. What do you think?
I would say that Bob Hall is not that stupid.
Who's that?
Bob Hall is he's basically, I believe he's the chair of the recession dating committee at the National Bureau of Economic Research. Mm-hmm. And I doubt that he is going to be saying at any point in the next 12 months that a recession started in the fall of 2023. You can take that to the bank.
All right.
I'm happy to talk about, but there's just, I don't even know where it's like, to me, it's like, if you say it's such an easily falsifiable statement.
Explain that. What data falsifies that?
Real incomes net of personal transfers have been rising since that period. Industrial production has generally been going up since that period. Consumer spending has generally been going up since that period. Corporate earnings have generally been going up during that period. If all the data is going to be revised down to show that nothing's happened over the last 2 quarters, tell corporate America. One reason behind the upward momentum in the equity markets has been upward revisions to earnings expectations predicated on the fact that the actual earnings numbers have generally been okay. I don't think that the National Bureau of Economic Research and Bob Hall, I would just say that it's unlikely that the NBER is going to declare that a recession started in the fall of 2023, because we know that Robert Hall, Robert Gordon, Christina Romer, David Romer, James Stock, Mark Watson are not that stupid. And these are all people on the recession data committee at the National Bureau of Economic Research. But if you just look at the data and think, real incomes net of transfers up and to the right, industrial production up and to the right, consumer spending generally been going up. We could talk about how much up it's going, but it's going up, right? So to me, it's a very easily falsifiable statement. So I wouldn't really put much credence into it. Now, we can talk about the risks going forward, and maybe there I would sympathize a little bit with that, but I think where I kind of land out on this is, do you think the Fed's ultimately going to get out in front with enough sort of time to spare or not? And, my sense is that would I prefer that they go in July? Yes. But if they don't, I don't think that waiting until September is going to be that detrimental to the economy. So that's kind of where, and I do expect their rhetoric to change over the summer. It's going to get increasingly dovish as the inflation numbers turn. The risk for the markets is if the rhetoric doesn't change despite that dovish or inflation news.
So if Neil Dutta was a member of the Federal Open Market Committee, the Neil Dutta dot would be 3 cuts this year.
Yeah, I would keep it at 3. It's sort of, I would be advocating for, if I was a committee member, obviously you lost the battle in June, and you've been losing the battle, particularly after the weak Q1 data. But I would very much be advocating for making more of an acknowledgement around the inflation progress. The last Fed statement characterized the inflation progress as modest. We'll see what the minutes say about that language being inserted. That was really the only change, as I recall, in the statement. They may have to find somewhat stronger language going forward, because the inflation data will continue to look weak between now and the end of the July, and at the end of the next meeting, which is at the end of July. So if I were on the committee, I would probably be advocating for somewhat stronger language in the post-meeting press statement, saying something stronger than modest, with respect to the disinflationary story. Maybe like continued progress, more progress, just be more sort of like firm about the progress on inflation, and then basically advocate that the chair uses that to send a signal that if the inflation data continue this way, we're going to be easing relatively soon.
Again, let's say if the Fed doesn't start cutting until later, it sounds like you think that the risks of a recession, of a slowdown will rise.
Well, yeah, I think what'll happen is that's when you get the accident. We talked about this earlier on the show. To what extent is the optimism in we can talk about, I don't want to talk about like NVIDIA and all these other things, but I think at some level, right, part of the enthusiasm in the markets is predicated on the fact that there's this expectation that the Fed's going to step in, just like a number of other central banks have stepped in, to recalibrate policy to kind of to sort of, course correct on the economic conditions. And that's probably one part of the reason for the enthusiasm in the corporate sector, is that part of the reason is that there was an expectation that they do cut rates. And so if they don't do that, then you could lose a lot of that, or you could sort of see a hiccup in the markets. So that's all I'm saying, is that the risk is the inflation data continue to improve, and the Fed is slow to the uptake. I think that to me is the main risk to the markets and the economy over the summer.
Got it. So it's not dire. The risk is that the Fed that doesn't cut too early enough, an overheated stock market would get a chunk taken out of it, but you don't have serious economic worries.
No, I mean, no, I don't think so. I mean, I think household balance sheets are still relatively healthy. I mean, but like I say, it's about risk management. It's about risk management. I mean, you don't want to get to a point where it becomes obvious, right? That's the goal. I mean, you don't want to get to a point where it becomes that obvious of what you should do. I mean, I think that's part of the challenge for investors is that we're so accustomed to the Fed cutting a lot or not at all, and we're not really used to them kind of doing these sort of modest course corrections or modest recalibrations of policy. And I think that's kind of the challenge. So it's not. I think if they do that, we can get back to sort of like a modest growth, benign inflation type environment. But you don't want to wait so long that you have to cut even more. And I think that's so if you're thinking about the Fed as a risk management enterprise. Right now you still have a lot of people that make the argument, well, if we cut just once, there's this big risk that things reheat right away. I don't really think that's the case. And Powell, I think, agrees with that. I mean, he basically said 25 basis points is largely inconsequential in the broad scheme of things. So if that's the case, you might as well go ahead and do it and see what happens. And I think, to me, if inflation continues to slow and you follow a simple rules-based type of framework, given what's happened with unemployment, that points to about 3 cuts. Once that happens, we can then talk about what the Fed should do next. I think they probably hold rates there, but I think let's get through that first, and then we can have the conversation about what happens thereafter.
Thank you for that. Irrespective of when the Federal Reserve first starts to cut, do you have a view on the type of rate cutting cycle? Is it going to be a 25 basis point cut, 25 basis point cut, and they get into a steady rhythm? Or do you think it will be pretty jerky stop and start kind of cycle?
I think it's more the latter than the former. I mean, I have a difficult time seeing how the Fed can. I mean, you do have some forecasters just assuming that the Fed's going to sort of glacially on autopilot cut 25 basis points every quarter. I mean, I just don't think there's any way of really knowing that this far out, frankly. I mean, I have a tough time seeing the Fed going, let's say the Fed starts in September. I have a really tough time seeing how they go more than 100 basis points over the next 12 months thereafter. Because I think if they do start cutting rates, I think you'll probably start to see some activity perking up relatively quickly, particularly in the housing market. But I also think that if you do get a new administration next year, I mean, that's going to introduce all sorts of different scenario analysis around, what is fiscal policy going to look like? What is tax policy going to look like? Is it going to be a reflationary economy again? So why would you be making big bets on Fed policy that far out into the future? So I'm not really comfortable yet talking about sort of a steady path lower. But I do feel pretty comfortable making the case for the short run. And I think given the fact that inflation continues to slow, you can make a very, very compelling case that the Fed should be recalibrating policy somewhat.
How are you viewing in terms of asset allocation, stocks versus bonds?
I mean, I like bonds over stocks here. The reason is because if you think about the most plausible scenarios, I mean, you've seen these sort of ISM investment clocks, and I mean, all of that's sort of, predicated on the idea that at any given point in time, the economy can kind of be operating in 4 different kind of phases, right? You have an inflationary boom-like dynamic. You can have a typical recession, which is a deflationary bust. You could have stagflation, which is weak growth, high inflation, or you can have, kind of modest growth, low inflation, sort of a soft landing type of environment. So at any given point in time, that's kind of where the economy is going to shake out, right? And if I think about the most obvious scenarios are the economy holds up and inflation continues to slow. That's what I would put the most weight on. And the second most likely scenario at this point is the economy slows and inflation also slows. So if I'm an asset allocator and I had to pick one or the other, I would, for that reason, take bonds over stocks, because in bonds can work in the soft landing story, because inflation would be coming down, so fixed income would rally, and bonds would obviously work in the in the slower growth, slower inflation story, because then people are not only buying fixed income because of the weaker inflation, but also the risk to the growth outlook. But there's not, I mean, to me, I don't see much of a stagflation risk. I mean, productivity is still okay. I mean, typically to get stagflation, you need to see some kind of negative productivity shock. I don't really see that. And, we talked about how growth isn't really getting away from the Fed. So it's also the likelihood of an inflationary boom-like scenario like we saw, maybe in 2022 and parts of 2023. I mean, that's also looks pretty remote. So, I think the odds of the other two scenarios are substantially higher. And so that's why I say, I think if they had to pick one, I would go with bonds over stocks.
So regardless of the growth scenario, you think there's a lot of disinflationary pressure in the economy. Just how much? How low do you think inflation, let's say core PCE, goes?
I mean, I think we'll be at 2% by the first quarter of next year.
Wow. So will the Fed be able to declare victory then?
I don't know that they'll declare victory, but they'll maintain an easing bias so long as inflation remains like that. Yeah. And, look, I mean, it's a lot of, I mean, again, I just come back to this sort of, if you're going to be so data dependent, you need to actually have some kind of views on the outlook for the data. I mean, I thought it was kind of amusing how Powell, at his last press conference, talked about, I'm sure you caught it, like the import prices, like, oh, import prices are firm for reasons we don't quite understand. And literally 2 days later, you had the import price data coming out, and it was a complete dud. It was like down like, 0.2% or something like that. But then it's like, think about first principles. I mean, is the dollar weakening this year? No, the dollar's generally been strengthening. So where's how are import prices? I mean, sometimes things happen in the data that you can't quite explain, but you have to have some kind of fundamental framework for how to think about things. And I think that's important to kind of stress, right? So with respect to inflation, if you think about a standard triangle model of inflation, right? So that assumes that that inflation is a function of some kind of aggregate demand variable, like the unemployment rate. It's a function of embedded inflation, like inflation expectations, basically inertia, and then some kind of cost push variable or supply variable, like the exchange rate or import prices. Based on that, you can't really come up with a good reason for why Q1 went up, right? I mean, why inflation in Q1 was so strong. You can point to things like financial services inflation and, for whatever reason, there was a big pop in consumer electronics prices, and maybe
recording media.
Yeah, maybe there was a big Medicaid adjustment or something. I mean, but there's largely idiosyncratic stuff. But if you think about first principles, I mean, was there a reheating of the job market in the first quarter? No. Were inflation expectations getting away from us in the first quarter? No. Was the dollar getting weaker? No. So, to me, it's important to kind of stick to those first principles. And that's one of the reasons why I think we're due for a bout of disinflation over the next several months. And I think as that becomes more clear, I think the fixed income markets in particular will welcome the news.
Neil, the last thing I want to ask you about is the Beveridge curve, which charts job vacancies to unemployment. Job vacancies, JOLTS, have been going down. I believe they're actually, not only well below their peak of probably 2022, but they're below trend of the trend line of 2019, which would be a very negative signal for unemployment. That unemployment rate would go up. How solid do you think is the theoretical framework behind the Beveridge curve? I know some economists, doubt the Phillips curve, which is the relationship between unemployment and inflation. How much of your view that the labor market is weakening is coming from this JOLTS job vacancy data in particular?
I mean, that's just one data point. But when I look at a broad range of data points, I mean, the labor markets, again, I mean, I think there are two ways to think about labor market data. There's level of activity. So basically a level of activity variable would be something like the unemployment rate or maybe wage growth, frankly. And then I think a momentum indicator would be something like, the rate of employment growth, right? Or sort of rates of change. And I think based on that, the labor market momentum, I mean, the Kansas City Fed does a useful kind of exercise with this, right? They look at things like employment intentions and labor differential and wage growth, and they have like sort of a composite kind of indicator where they put all these things into a simple model. But basically, in order for the level of activity to continue improving, the momentum has to be above normal, and it doesn't look like that's the case anymore. I mean, the momentum in the job market is not as strong as it was a year ago, and that's by a variety of ways you can see that. I mean, look, if you look at initial jobless claims, I mean, they're slowly going up. If you look at hiring rates, they've been coming down. They're, quits rates, there's very little turnover in the job market. So I think it's not just the beverage curve. That is one useful illustration, I think. But I think more importantly, it's, the unemployment rate has been rising, even with growth, GDP growth running relatively strong, which would suggest that if growth does weaken, that there may be even more upside to the unemployment rate. So I think, to me, it's about that distribution of risks, right? So, I think the risk is that the unemployment rate maybe goes up another tenth or two. But I would also expect, if that were to happen, that the Fed adjusts relatively quickly. Remember, the Fed has been leaning in very hard into this idea that we have this, sort of immigration story, right? I mean, there's been a big supply response in the job market. If that's true, that means if employment does in fact slow, all else equal, that means that the labor markets are even worse, right? Like if you think all the jobs growth is basically a supply side story, and then the jobs numbers start to weaken, then, that means that demand is a lot worse than you think. And so if that's the case, you would start to adjust policy sooner. So I think that's something important for people to kind of keep in the back of their mind over the summer.
Got it. And then, so Neil, if in 2022 and 2023, so many people were saying recession because of the soft data or polling data, basically, such as PMIs and stuff that was weak, consumer sentiment was weak, but the hard data was fine. Now you have the hard data weakening. You're getting a little more in the slowdown camp, or less in the no landing, soft landing camp. But the as the hard data weakens, but the soft data, the ISM, which was weak in 2023, the composite PMI is now at 54.5. So what's going on there?
Yeah, I mean, I think you just look at these data points holistically. I mean, I think the survey data is a reminder that the economy is not falling out of bed. But it is, I would say that it is slowing. It's also important to remember that, there's I would just say that there are some parts of the economy that look better than others. And I think that to me is what's important, right? Like, so if you go down the list, right, we know that inventories have been pared back quite a bit, right? There hasn't been much of an impulse for inventories, even though consumers have still been buying things. So I think retailers need to restock inventories, as they do. That should provide some support for manufacturing. At the same time, a lot of what we manufacture, a lot of our exports are manufactured goods, and we know the global economy is not as weak as it was a year ago, right? So, you mentioned the PMIs. I mean, that's not just true in the U.S., but we've also seen some of those numbers perk up in Europe in particular, but also in China, Asia, right? So to the extent that that's true, the fact that global growth is picking up should help U.S. exports. So that could be one reason why things like the ISM, have rebounded somewhat. These PMIs have rebounded. I mean, these sort of cyclical areas look a little bit better. But there are other areas of the economy that aren't, as strong, right? Like, so it's an economy firing on some cylinders, certainly not all cylinders. And I think when you put it all together, you get something around two.
And regardless of who wins in November for both the White House as well as Congress, do you have a view on how that will impact the size of the fiscal deficit and the overall economy?
I mean, I tend to steer clear. I mean, I think the way I think about the election is that if Trump wins, the likelihood is that you get a unified government, and if Biden wins, the likelihood is that you get a divided government. So if you have a divided government, probably you get a little bit more fiscal consolidation. If you have a unified government, you'll probably have more fiscal expansion. That's how I would think about it right now. Beyond that, I don't really have much to say.
Neil, great to catch up with you. Thanks for coming on, sharing your views. Where can people find out more about the work that you do at VanEck, and then tell us about the other services that VanEck provides?
Well, so RenMac, Renaissance Macro Research, is a sell-side broker dealer specializing in the sort of core tenets of macro investing, which is economics, policy, market strategy. It was founded back in 2011. If you want to get sort of more sense for our process, I would encourage you to go to www.renmac.com. You can also follow us on Twitter at RenMacLLC. And we're also building out a platform for RIAs, retail investors, to kind of give you a sort of small flavor of what we do for our institutional clients.
There we go. And so Neil, if you were on the FOMC, your projection for the inflation core PCE would be below the median 2024 forecast, and your unemployment rate projection would be above the median 2024 projection. I almost said podcast. That's meaningful to me. Neil, thanks again, and thanks everyone for watching.
Thanks, Jack. Good to be with you.
Thanks for watching. Remember to check out vaneck.com/MOATFG to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, Forward Guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.